Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in this video, we're going to be talking all about multi-baggers. Now, multi-baggers are a concept first presented by Peter Lynch in his book, One Up on Wall Street. And basically it describes when you invest in a stock and that stock returns many multiples of the amount that you put in. So if you put in $1,000, potentially that stock can 5x, that would be called a 5-bagger. And it goes to kind of 5 times the initial value that you put into that stock. So multi-baggers are great for your financial health and great for your returns. And I want to present a couple of ideas today of 2 pretty simple but very important ideas that really drive these big multi-bagger returns. So in order to achieve that, I'm going to combine some of Peter Lynch's concepts from One Up on Wall Street with Chris Mayer's concepts from his book 100 Baggers, where he talked about stocks that return 100 to 1. So massive home runs in terms of stock investments. Now, there's going to be 2 basic ideas that I talk about from these books, and that is earnings growth and multiple expansion. Pretty basic ideas, but I want to give you some examples of where each of those investment styles have worked, when you can combine both of them and sort of supercharge your returns, and also some things to be cautious of and making sure that you haven't just got one with the other kind of working against you. So a few things to talk through there. I do hope you enjoy, and let's get into it. Now, one quick thing to say just before we get started is I recently put together a video with Brandon from the New Money YouTube channel talking all things Berkshire Hathaway, particularly focusing on what happens after Warren Buffett is gone. So if you want to go and check out that video, I'll leave a link to it down in the description below. If you've come across from Brandon's channel, welcome, and I hope you enjoy the content on the Investing with Tom YouTube channel as well. Okay, so 2 core concepts which drive multi-baggers. The first one is earnings growth. Pretty straightforward. The company earns more money over time and therefore demands a higher valuation in the stock market over time. And the second one is earnings expansion. People paying more for that company for every dollar of earnings, maybe realizing it's a higher quality company or realizing it potentially has more growth opportunities ahead. In other words, people pay a higher PE ratio for that stock over time. So let's give some examples of both, and let's start with the earnings growth side of this multi-bagger equation. So there are numerous examples of earnings growth driving stock returns. Frankly, any business that has really large stock returns over time will have some growth built in. But I want to give you the example of Apple from 2011 through to 2019, because this is an example of a stock where all of the capital gains, all of the returns in terms of the stock price going up was entirely driven by earnings growth. So if we think back to 2011 and talk through some of the stats for Apple. Now, in 2011, Apple was trading at a PE of around 14.3. They had earnings per share of about 75 cents, and this is all adjusted for stock splits and everything that's kind of happened recently. They were earning about 75 cents per share, and the stock at the time was trading at a little under $11 per share, about $10.74. Now, what happened between that day in 2011 and then fast forwarding through to 2019 is Apple experienced spectacular earnings growth, particularly driven by their iPhone sales. Now, in terms of what happened with the stock, the PE ratio stayed about the same. So in 2011, the PE was about 14. In 2019, the PE was about 15.7. So minor increase, but next to no change. Now, what really drove the stock returns for Apple were earnings growth. So the earnings per share went from 75 cents in 2011 per share right through to $2.97 per share, almost $3 a share over that sort of 8-year period is what they grew to, and that was right about a 4x in their earnings per share. And we had minimal changes in the PE ratio, we had a slight increase, so that rough 4x in earnings resulted in about a 4.3x in the stock, with that sort of slight increase in earnings multiple sort of built in. So that is the first thing that's going to drive multi-baggers. It's a very straightforward concept and something that Peter Lynch and Chris Mayer both talk about in their books extensively, is just focusing on earnings growth and buying into companies that are growing over time. Now, with Apple, I think it's very important to note that with Apple, you were never forced to hold the stock through that 2011 to 2019 period when it was trading at some crazy high earnings multiple. It was always trading in and around that 15, fluctuated kind of in and around that through that 8-year period, but it was never up at 50 or 100 or 200 times earnings or anything crazy. The returns were solely driven by earnings growth. and you weren't having to sit there holding on to shares in Apple when it was getting to, speculative, crazy high prices with a ridiculous PE ratio or anything like that. Now let's look at another example which is frankly quite the opposite. This is an example of a business that had basically flat earnings over about a 10-year period, but they experienced multiple expansion. People started to pay a higher PE ratio for the company over time. So this is something that you might experience if you're sort of a deep value style investor and you're, trying to buy, basically stable businesses trading at half of what they're worth, and then they appreciate up to, what they're fully worth and that sort of thing. So let's give you an example of that. Now, the company I'm going to talk about now is one that's been in the news quite a bit lately, and that is Pfizer. So we're going to look at Pfizer from 2011 through to 2020. Now, back in 2011, Pfizer was trading at quite a low PE ratio. They were trading at about 8 times earnings, or a little over 8 times earnings. Now, what happened between 2011 and 2020 is that the PE ratio of Pfizer expanded a lot. It roughly tripled. It went from about 8.1 times earnings all the way up to 26 times earnings. So what drove that multiple expansion? Surely they're experiencing all this massive growth and people are expecting huge things out into the future for Pfizer. Well, basically if you look at the underlying earnings from 2011 to 2020, they went from about $1.45 a share in 2011 through to $1.55 a share in 2020. The earnings were basically flat through that entire period. Now, granted, Pfizer have actually earned more than $1.55 in the last couple of years, so potentially investors are banking on higher earnings over the next few years. But nonetheless, if you take a snapshot in 2011 and a snapshot in 2020 and just frankly look at the earnings between those 2 points, they are basically unchanged. But regardless, you had a stock price that went from about $12 a share all the way to about $34 a share, and you captured close to a 3x with basically no earnings growth. So what actually drives multiple expansion when you're looking to, capture one of these multi-baggers? Well, frankly, it's much trickier to determine than earnings growth. It's relatively simple to predict a business that you think is going to grow over time, particularly if they've got a really strong brand or great product or something, like in the Apple example. With something like Pfizer, it's much more difficult to predict this multiple expansion. There are a few fundamental things that drive it. The first one, frankly, is low interest rates. I'll put up a market average sort of PE ratio on this screen, and you'll see that over time, PE ratios have been going up generally as interest rates have been going down generally over the past couple of decades or so, really. And the other thing, frankly, is speculation. Now, speculation is something that ideally as value investors we want to stay away from as much as possible, but it does exist, and it is something that will drive these higher multiples over time, particularly with something like Pfizer, which has been in the news a lot lately. Okay, so there are a couple examples where we get earnings growth driving a multi-bagger and we get multiple expansion driving a multi-bagger. But, Tom, those are only 3 5Xs. Where's the 10 baggers? Where's the 15 baggers? Well, let's talk about that. And basically that is driven by combining these two. If we can get both earnings growth and multiple expansion, we can sort of pour fuel on the fire for getting these massive outsized returns. And the example I want to use in this video is Monster Beverage. Now, many of you will know Monster Beverage and all their energy drink products and brands and so on. So basically here are some of the stats. And I'm going to go from 2008, the depths of the recession if you had bought Monster, back through the global financial crisis, through to 2020. Let's have a look at what's happened. Now through that period, Monster experienced massive earnings growth. They grew earnings per share from about 30 cents per share in 2008 right through to about $2.23 in 2020. That, to do the maths for you at home, is about a 7.4x multiple in their earnings. And if they had kept a stable PE ratio through that period of time, you would have captured about a 7.4x on the stock as well. But the interesting thing that happened with Monster is their PE ratio didn't go the same. It actually went up quite a bit. So back in 2008, the PE ratio was about 17. If we fast forward through to today, it is about 36. It has approximately doubled. So if you get a little over a 7x from the earnings growth, and then you get a little over a double from the multiple expansion, then what you end up with in terms of stock price appreciation is you get about a 15 or 16x if you kind of combine those two multiples. Now, that took the stock from about $5 per share in 2008 through to about $80 per share today. And that is how you get the massive multi-bagger home run stocks, as you combine both earnings growth and multiple expansion, and it turns into crazy returns. Okay, now I want to give just one word of warning before I wrap this video up, because frankly, I think a lot of people see these types of concepts, particularly on the growth side, and think that they can just invest in really high growth businesses and get good returns. And that is not always the case. Now, in this video, we've talked about two drivers of return. We've talked about earnings growth and multiple expansion. Now, what you need to have happen in order to capture these good returns is you need at least one of these things working in your favor. With Apple, it was the earnings growth. With Pfizer, it was the multiple expansion. And with Monster Energy, it was both. Now, what you have to avoid at all costs, and what will absolutely destroy a multi-bagger, is one of those things working for you and one of those things working against you. Now, let's take the example of a company with really high earnings growth and where multiple expansion actually does the opposite and those multiples contract. Now, one of my favorite examples of this is actually Microsoft. Now, Microsoft was an absolute darling of the dot-com bubble. It was one of the rare businesses during that period which was actually printing money and producing a lot of cash flow, and it still had huge growth prospects moving forward. Now, the mistake that people made is, although Microsoft had this really good, high growth rates that they managed to achieve moving forward, they paid too high a multiple, too high a P ratio for this company. So here are some of the stats for Microsoft, and we're going to look from 1999 through to 2015. So in 1999, sort of peak tech bubble here, Microsoft was earning about 71 cents per share. The PE ratio was 66, really high PE ratio, and the stock was trading about $50 per share. Now, if we fast forward to 2015, Microsoft had gone ahead and grown their earnings really, really well. They had grown their earnings from 71 cents per share to $2.41 per share. They had about tripled, a little over tripled their earnings, about 3.4x over that time. So they've definitely ticked the first box. Just like Apple, they have grown their earnings substantially, but the kicker here is that the PE ratio has worked against us to quite a significant extent. Now, remembering that Microsoft was trading at about 66 times earnings in 1999, if we fast forward to 2015, Microsoft was only trading at about 15 times earnings. So here we have a situation where Microsoft's earnings have gone up about 3 or 4x. The multiple placed on that business has done like a reverse 4x. It's gone down to about a quarter or less than a quarter of what it was. And basically you have these two things cancel each other out. So if you look at the stock price of Microsoft in 1999 of about $50 per share, and then fast forward to the Microsoft stock price in 2015, it is also about $50 per share. So that's my word of warning, and something that you definitely have to watch out for. You can't just buy really high growth businesses and pay huge multiples for them. If you pay, say, 100 times earnings for something and you think their earnings are going to 5x over the next decade, well, if their earnings 5x and they go from earning, say, $1 per share to $5 per share, but the PE ratio goes down from 100 to 20, that means that the stock price has gone nowhere over that 10-year period. So it's important to try and get both these variables working in your favor if possible, and that is what can produce these absolute multi-bagger returns. So that is all from me today. If you enjoyed the video, please hit like and hit subscribe. Interestingly, this video topic was actually suggested by one of you. I put up a community post the other day asking for video ideas because every now and then I completely run out of them, and this was a suggestion, how to look for multi-bagger stocks. So if you've got a topic that you would like to see me make a video on, definitely drop it down below. But that's all from me today, and I will see you in the next one. Cheers.